Hi, I'm Steve Neal, and this is Timbo, and thanks for joining us here on a catastrophic event for the second part of my interview with the former investment manager for Spokane County, John Christina. Today we dig deeper into the rising costs of goods and services and what causes inflation.
I didn't hear that, Steve. It's amazing.
Yeah, sign me up, would you?
Yeah. And the second part of your question had to do with the auto industry and why the price of cars is so high. I think one of the things is the technological advances that have been made in cars. My first car was a 1965 Dodge Dart with a slant six, 225.
Dude, a cruiser.
It was great. It was a great little car, and I could actually do the work on it myself. I could change the spark plugs. I could change the oil. I learned about how to deal with adjust a carburetor and how to put points in there.
Right, the points. Yep.
You remember those days?
And the little button for high, low.
High, low, yep. Yep. That little thing, and for air conditioning, we had vents on the driver and the passenger side. You open up the vents and it would cool off your legs. And if you wanted to cool off your upper torso, we had corner windows. You'd open up the
280
corner
air conditioning.
Yep.
80 miles an hour.
Yep.
Ready to go.
But and now everything is more automated. It's electronic. We don't have manual window anymore. It's all electric.
Yeah.
The computers that are in cars now, we never had those before, and just the amount of technology that's in there is just amazing. We didn't have to worry about things like exhaust gas return valves and things like that.
Hundreds of sensors.
We'd have a PCV valve. You pull it out, shake it to make sure it was still good. You put it back in. But now you've got this incredible, system for recycling exhaust gases, catalytic converters, all that stuff. The computers that are on board. So technology, I think, has really been one of the big factors of why we've seen the increase in car prices. On top of that, maintenance costs. It costs more to maintain them, and of course, the higher the price, they have to come up with creative ways to finance.
Right.
So it used to be that, back in the day, you could finance a car over 3 years and you'd be done with it. Well, now they're financing cars over, 7 or 8 years?
Yep. Yeah, well, when a truck is $100,000 for a 3/4 ton with a bunch of options, good grief, my second house, was $97,000. Mm-hmm. $97,000 for my house.
Wow.
And it's just mind blowing to me. In fact, I was watching a show the other day. This guy was walking around a Ford dealership, and he was looking at those Ford Broncos, and they had a dual door Ford Bronco. Must be a step up. Must be a step up.
The OJ edition.
There you go.
The 20th anniversary edition.
Anyway, they had that on there, and it was $96,000 or $97,000 for this Bronco, and I'm like, wow,
Yeah.
Who can afford that?
Absolutely. It's so difficult for particularly young people just starting out to afford a house, let alone a car. And the associated costs that go along with it. Insurance is going up on both housing and on cars, maintenance, of course, and just the cost of debt. I mean, that's a significant amount too. As interest rates go up, so does your cost.
Yeah, and one thing too that has to be included in all this is government mandates.
Yep.
These cars have to get 380 miles to the gallon, but it has to have a 2-gallon tank, and it can't do this and it can't do that, and so the car manufacturers have to do all this engineering and reworking of this and reworking of that to make sure that they meet all these standards that may or may not be on point.
Yeah. Well, the government influence in our markets has been incredible. It's just increased so much over the last 30 or 40 years.
Yeah, it has. And it's unfortunate because you and I and the rest of the common folk get to pay for that privilege,
Right.
whether you agree with it or not. So okay, the next question I have is last March, we had the three biggest bank failures adjusted for inflation in our nation's history. This year we had another major bank go. So what caused it, and do you expect more failures in the future?
Well, let's start out with what caused it. I think the biggest cause, based upon what I've read, there's two factors. One of them is what we in the business call chasing yield, and I'll talk about that in a minute. And the second one is just the poor risk analysis. The risk is just absolutely horrible. If we talk about yield, how do I put this?
We're in trouble.
We're in trouble, yeah. But the effective yield that occurs when you have investors or people within the bank who are investing, they're purchasing bonds and notes. And let's say they go long, they buy a long-term bond, say a 10-year bond, and maybe at the time it was paying, maybe 5% interest, let's say. And so if you hold a bond to maturity, you're going to get your money back and everything's great. But what happens if you're, and particularly in the case of Silicon Valley Bank, I'll use that as an example. Number one, it was very heavy in the tech sector. It was based in San Jose, California, I believe, where all the tech is. So there was that risk of sector risk, with all those companies that were technological companies. And for whatever reason, they began withdrawing their money. The bank had invested long term, and in order to cover all the withdrawals, they had to sell some of those bonds. Well, if you have a bond, a 10-year bond, that's paying like 5%, and the market is now saying, well, you can buy a 10-year bond now, and we'll give you 7%. How do you sell that bond? What you have to do is you have to reduce the price of that bond so that it's equivalent to what you could get in the market right now.
Oh, that's how it works. Okay.
So that's what happened. That's probably the biggest factors happened was that, they were chasing yield. They wanted to get the best yield possible without considering they do have cash flow needs. They're a business and they do have cash flow needs that are going to be coming up. And so that's what happened. The depositors started taking money out, and the only way they could get around it was to start selling those long-term notes, to take advantage of that. So that was the big thing.
From what I understand, another part of that is what do they call it? Unrealized losses.
Mm-hmm.
And a good example of that was I think it was 6-7 months ago in San Francisco. There was a pair of hotels that they were two of San Francisco's biggest hotels. I don't remember the name. It's been too long, but. Anyway, those two hotels, because of the drop in commercial real estate value in San Francisco, was so significant, they had taken loans out on those buildings for $100 million or something along those lines. Mm-hmm. Well, those buildings are now only worth $25 million. Yeah. So.
They're upside down.
Right. I mean, by $75 million or more on this one building or on these two buildings. And so you now have a situation where that bank, they can't sell that building to get anywhere near what they owe.
Right.
And that's two buildings on one bank. And when you consider that the biggest, that most big buildings are upside down now nationwide.
Oh, yeah.
That paints a pretty ugly picture.
Yeah.
But that's just me.
Oh, yeah. Well, banks are not in the business of buying houses. I mean, that's not their business. They're buying and renting them out. I mean, they're there to provide financing for people to buy houses. So that's not their main business. And so when something like that occurs, I mean, it really does have an impact on their bottom line. And getting back to Silicon Valley Bank, one of the other things that really caused this problem was their lack of risk analysis. and particularly in the case of Silicon Valley Bank, I think the gentleman's name was Sam Bankman-Fried, and he had, I don't know if he parceled out risk analysis and compliance to his girlfriend or whatever, but she was interviewed on TV, and she said something that really was startling. She said that we didn't believe that stop loss was an effective measure for mitigating risk. Well, anyone who is investing knows that stop loss is a great way to minimize and mitigate your risk.
What
potential on the
is stop
downside.
loss?
Thank you for asking. Stop loss is when you go in and buy an investment. Let's say that you buy 100 shares at $10 a share of XYZ Corporation. Okay, you can actually put an instruction in there that says, okay, if this $10 share drops down to $9, I want to sell it.
Okay, so it minimizes your loss.
Right, it's a hedge and it stops the loss. So you're basically saying, if it goes down to 9, I'm good, just sell it and I'll make it up later. And so when I heard her say that stop loss was not an effective risk mitigation strategy, I just shook my head and said, wow.
They obviously
That's a
were
problem.
smoking something.
Right, and you know, I think it might have been lack of experience. This was a young lady, and you know, she may not have a lot of experience in the market. But when you're dealing with people's money, other people's money, and they were dealing with other people's money, you don't handle it frivolously. You have a fiduciary responsibility to those people.
Or at least one would hope
One would hope.
that there's some kind of, moral code with somebody
Yeah.
else's cash.
Yep. And the other thing is, where were the regulators? Why did the regulators not catch it in time?
One of those mysteries, isn't it?
What else needs to make you say, yeah.
I don't know. But, yeah, they just seem to disappear at the opportune moments, don't they?
It's amazing.
Yeah. Okay, so the stock market goes ballistic every time Fed Chair Jerome Powell talks about interest rate cuts. At the beginning of the year, he was talking about several cuts, but not only have they not happened, but now he's only hinting at one this year, and he's kind of even on the bubble on that one. Why would the stock market react so positively to mere rumors of lowering the interest rate, and why wouldn't Powell go ahead and just make these rate cuts?
Well, that's another good question. The Fed has two responsibilities. One is to maintain economic stability in the country, and the other is to try to maintain job levels at a certain level. So he's got to balance those two different ways. And why the markets like it, if he comes out with positive guidance that says, looking forward, we're looking at maybe one rate cut this year, the markets like that because they know the cost of borrowing is going to go down. And that also means that their profits are potentially going to go up. So that's a beautiful thing. An investor out there, when you hear that that's going to happen, you may want you to maybe consider investing a little bit more than what you were doing.
Oh, because the potential profit is more
Exactly.
than what it was. I see. And so why wouldn't he go ahead and cut the interest rates? Like right now, I mean, if there's profit to be made, as you said, if there's blood in the streets, why wouldn't they do that?
Well, he's looking at seeing what's happening in the economy and all the different sectors in the economy, and he's got to make that decision based on what's happening. If you cut too much or if you don't cut enough, that's going to impact what's happening in the economy overall. And so it's definitely a judgment decision. I think that in the environment we're in, if we only have one rate cut this year, that'd be pretty darn good.
Okay.
Yeah.
So since, let's see, in reality, one thing that he's very concerned about, or theoretically concerned about, is inflation. And that's another consideration on why they don't want to lower the interest rates, because I know that they tell you that interest rate, or not, inflation is only, like 0.3% or some slightly fictitious, slightly off number. But every time you go to the store, you see the truth.
Big time.
And, whether you're buying food, whether you're buying stuff from Amazon, whatever. Like a classic example is I buy beetroot powder because I have high blood pressure, and that helps with high blood pressure. So, well, the stuff I've been buying has been $29.99 through Amazon. Well, I went because I needed another container of it. I went the other day and it was now $35. That's a pretty significant increase, and I think that's more than 0.3%. My math is kind of hazy, but I think that's more than 3%.
It's more like 20%, yeah.
And so anyway, why don't you go ahead and tell us, what is inflation?
Okay, well, very simply, inflation is when the money supply is increased in the economy. The Fed basically prints more money. And so now you have more dollars chasing fewer goods. So the demand is increased. So as demand increases, you can increase your prices to meet that demand. So the high prices that you see are not inflation itself. It's a result of the Fed inflating the money supply by adding more dollars into the economy.
Which is also a hidden tax.
Oh, yeah.
Yeah. Okay, so we'll get off that. Every time they release the consumer price index numbers, inflation comes in higher than expected. Wow. Why is that?
Well, the consumer price index is a very interesting thing. And there's a couple of indicators that you really look at when you want to see what the economy is doing. The biggest one, I think, is consumer price index. There's also producer price index, where you can follow the cost of businesses and what their costs and how their sales are doing. But the consumer price index is based on a basket of goods. And I love this because they go out there into the economy and they'll grab all these different things that people need, like clothing and things like that. They'll put it in the basket. They'll figure out what the valuation is on it at this point in time. Which is all well and good, except for one thing. That basket of goods does not include food or fuel.
Who needs food?
So if I didn't have to put gas in my car, and if I didn't have to eat, I think I'd do pretty well. Maybe that 3% figure is probably pretty accurate. But when I go to the store and I find out that a piece of meat that I paid $3 a pound for 3 or 4 years ago is now $13 or $14 a pound, that sure doesn't sound like 3% to me.
Yeah. And every time you go to Costco, you look at the prices, and every time I go there, at least one item has gone up $1 or $2 every single time. Yep. And it really gets depressing because, I used to be able to go in, it's just my wife and I. Mm-hmm. I used to be able to go in there and be able to buy $100. And that was good for the 3-4 weeks, maybe a month, whatever. Mm-hmm. Now, it was 180, 170, $180. And I'm not buying what I did.
Oh, I know.
Yeah. I'm not buying anything like I did. Homie is just buying the basics. Mm-hmm. And it's just, like I said, it's really quite depressing when you see how little you buy. Like over at Trader Joe's, I buy breads and things like that because they have stuff I can eat because of my allergies. And I was spending $25, give or take, every couple of weeks. Well, now it's $45, and I'm still getting the same little baggie of stuff. And I'm like, wow,
yeah,
kind of hurts.
When I first struck out on my own as a young man. And going to the grocery store, and having an accounting background, I used to think about things like, if I go to the grocery store and I pay $40 and I have 4 bags of food, that's about $10 a bag. And I've always kept that in the back of my mind as just a kind of a mark to see where we're at today. Going to the store the other day, I have 2 bags of groceries, and it cost me $55, I believe it was. So that's what happens over the course of 40 years. It's just amazing.
Yeah, it always sticks with me, and it always will. When I was a kid in California, I remember my mom, in my family, there was 5 of us, my mom, dad, and 2 siblings. And we went into she took me into Cal Store, which was a grocery store back in the early 70s in LA. And I remember to this day, she had a cart full of junk. I mean, my brother used to eat as much as the rest of the family combined, no lie. I mean, that guy was like, pfft. And anyway, she handed the checker a $20 bill. And she got change back, like you used to do at McDonald's.
Yeah.
Well, that cart was full. You ain't doing that now.
That's for sure.
I mean, the other day at Winco, there was a young lady, and she had a cart full of questionable stuff, but it was a cart full of stuff. Well, I mean, it was almost $500.
Yeah.
And I can't imagine that.
Yeah.
How in the world you're going to pay for that? And like I got a bill yesterday actually for my homeowner's insurance. Nothing happened in my home. I didn't do anything to it, but it went up $80.
Wow.
And I'm like, ow! My income didn't go up $80.
Yeah. Yeah, it's a phenomenal what we're seeing out there. It really is crazy. And you mentioned, McDonald's, $20 getting change back. I don't know if you get change back from McDonald's now if you just bought a Happy Meal and a Big Mac and a fry. You may not get money back from that as the prices have gone up so high.
It's absolutely insane. I don't know how people are still going out to eat as much as they do. I mean, here in Spokane, there's restaurants everywhere. And it just astonishes me how many restaurants there are here in Spokane. But they're so expensive, I don't know who's affording it. I mean, unless they're just putting it on their credit cards and waiting for the ball to bounce on those.
Yeah.
I don't know what they're doing because.
Well, you take leftovers with you. You got another meal the next day, so that may be part of it. But I feel really bad for restaurant owners out there in particular, and any small business.
Right.
Just to open the door every day, they have fixed costs that they have to cover. The cost of insurance, taxes, everything else. But then they have to pay their employees, and government's mandated. Was it $20 an hour?
Yeah.
Pretty close to that.
I don't know if that's in Washington yet, but I know in California it is.
Yeah.
And they've already laid off 10,000 workers since that came in.
Yep.
I guess bonus for the 5 who are still working.
Yeah.
But the rest of the guys,
Yep.
I guess unemployment fits you well.
Yeah, and it's not only labor costs, but the cost of goods is going up still.
Right.
And we talked earlier about supply chain issues. I mean, I think that's still a problem with supply chain issues, and so and particularly in the food industry. I mean, how many times have we seen food processing plants that have caught fire? That's going to raise the price of food as well. So
Yeah.
it's a challenge for any small business owner, any restaurant owner to try to make a living and yet provide a good product to the consumer out there.
Well, yeah, that, and I mean, let's face the facts. The how do you say this politely? The quality or the willingness of people today to put in a hard day's work for the wages that you earn has diminished greatly. I mean, I know that that's one of the complaints I heard. And, when I used to work in HR, that was one of the biggest problems. And that was several years ago. I can just imagine how it is now on how people don't want to work. And, they don't want to show up on time. They don't, whatever. Well, a business owner can't function that way. You have to be able to show up on time and give them a good quality of work. Well, if you don't, then I guess that's where robotics comes in.
Exactly.
Burger flippers when they just buy a robot and this guy can flip burgers all day and he's never late.
Yep, and never has to pay $20 an hour for them either.
Right. We're kind of circling the wagon here. We kind of discussed this, but are CPI numbers the government gives accurate concerning inflation? Are they smoking stuff, or are they giving us the honest to goodness lowdown?
Steve, I think they're making their best effort that they can. A lot of it is based on projections. A lot of it is based on, a snapshot of what it is right here in time, right now. But that market basket of goods that we talk about in the CPI, it's pretty easy to figure out what the average cost of a shirt is, or the average cost of a pair of shoes. So I think the numbers, they try to get them as right as possible, but there's also a thing, and I hate to talk about it again, but there's the political aspect of what the government numbers say. And so that 3% number, like we mentioned earlier, is probably inaccurate for the overall economy. But for those particular items in the basket, it's probably pretty close.
Well, one thing in that, just throwing this out there, it doesn't matter whether it's Republican or Democrat in the White House. They all have to look good.
Right.
So they're going to shave numbers. They're going to shade things out. There's a lot of funky stuff going on in both parties because both of them ultimately want to be elected.
Right.
And honesty's way back down the road somewhere. And it's sad because they would rather get elected than tell us the truth.
Well, that's their number one priority. Any politician. They may not tell you that, but their number one priority is to be reelected.
Yeah. Okay, so turning the corner here.
Yeah.
We're going to go ahead and look into investment.
Okay.
Is this a safe market for investment?
Well, that's kind of an interesting question.
Loaded?
Loaded, maybe, yeah. I guess there's a safe market somewhere, but in all actuality, every market, wherever you invest, there are risks involved. And so what you do when you're talking about getting ready to invest, you need to find out what your risk tolerance is. How much risk are you able to tolerate?
Thank you for listening to our interview. For those curious about inflation and how it affects you, we have provided links below the video on our YouTube channel and on the resource tab of acatastrophicevent.com. Please remember to like, share, subscribe, and leave a comment on this video, and thanks for watching.